Many people enter the world of investing with excitement. They search for the perfect stock. They look for the secret formula that promises fast wealth. They believe success comes from clever predictions and quick decisions. But the truth about investing is often surprising. Successful investing is not mainly about intelligence. It is about temperament, patience, and rational thinking. The legendary investor Benjamin Graham once explained that the investor's chief problem and even his worst enemy is likely to be himself. This idea may sound simple, but it contains deep wisdom. Markets move up and down every day. News spreads fear and excitement. Crowds rush toward trends and abandon them just as quickly. In this environment, it is easy to become emotional. It is easy to follow the crowd, and it is easy to forget the principles that create long-term success. Rational investors learn to step back from this noise. They understand that investing is not a game of speed. It is a process of careful thinking over long periods of time. Warren Buffett once said that investing is simple but not easy. The ideas themselves are straightforward. Buy good businesses, pay reasonable prices, hold them for long periods of time. Yet following these simple ideas consistently requires discipline and emotional control. A rational investor builds habits that protect clear thinking. They focus on understanding businesses rather than predicting market movements. They care more about long-term value than short-term price changes. The great thinker Charlie Munger often reminds investors that the big money is not in the buying or selling, but in the waiting. Waiting requires patience. Patience requires confidence. And confidence comes from understanding the principles that guide rational investing. This is where the journey of this book truly begins. Before an investor learns strategies or analyzes companies, one mindset must be established first. The mindset of thinking beyond the present moment. Because rational investing always begins with time. Short-term thinking leads to emotional decisions. Long-term thinking creates clarity and discipline. For this reason, the first rule of rational investing focuses on the most powerful advantage an investor can develop: the ability to think far beyond the present. This brings us to the first principle of the rational investor. Rule 1. Think long-term. The first rule of rational investing is simple in words but powerful in practice. Think long-term. Many people enter the market with short-term expectations. They buy a stock today and hope it rises tomorrow. They check prices every hour. They react to every small movement in the market. This behavior creates stress and confusion. It also leads to poor decisions. Rational investors see the market in a completely different way. They understand that the market is not a place for quick excitement. It is a place where patience quietly creates wealth over time. The famous investor Warren Buffett once said that the favorite holding period is forever. This statement surprises many beginners, but it reveals an important truth about investing. When investors buy pieces of strong businesses and allow time to work, wealth grows naturally through the power of compounding. Compounding means that money begins to earn money, and then the earnings themselves begin to earn more money. Over time, this process becomes extremely powerful. The scientist Albert Einstein reportedly described compound growth as the most powerful force in the universe. Whether the quote was exact or not, the idea behind it remains true. Small gains repeated over long periods can produce extraordinary results. But this process requires patience. Many investors destroy the power of compounding because they cannot wait. They sell too early. They jump from one idea to another. They chase excitement instead of discipline. Rational investors understand that wealth creation is slow and steady. Consider the growth of a strong business. A good company does not become great in a single year. It builds products. It attracts loyal customers. It improves management decisions. It expands into new markets. All of this happens gradually. Investors who think only in the short term rarely benefit from this growth, but investors who hold for long periods allow business success to reflect in the stock price over time. This idea was also emphasized by Benjamin Graham, who explained that the market behaves very differently in the short term and the long term. In the short run, the market behaves like a voting machine. Prices move based on opinions, excitement, and fear. But in the long run, the market behaves like a weighing machine. It measures the real value created by businesses. Short-term movements are unpredictable. Long-term value creation is far more reliable. This is why rational investors spend less time predicting prices and more time understanding businesses. They study how companies make money, they analyze the strength of the business model, they observe management quality and long-term growth potential. Once they find a strong business at a reasonable price, they allow time to do the heavy work. Time becomes their greatest partner. Another problem with short-term thinking is emotional pressure. When investors watch prices constantly, they experience a roller coaster of emotions. Small declines create fear. Small increases create excitement. These emotions push investors to take unnecessary actions. The great investor Charlie Munger often explained that the big money is not in the buying and selling, but in the waiting. Waiting allows rational thinking to replace emotional reactions. The longer the time horizon, the less important daily market noise becomes. A rational investor may look at market prices, but they do not allow those prices to control their decisions. They remember that owning a stock means owning a small part of a real business. If the business grows stronger over time, the investment will likely grow as well. This perspective changes everything. Instead of asking what the market will do tomorrow, rational investors ask a much more important question. Where might this business be in many years from now? This shift in thinking transforms investing from speculation into ownership. It encourages careful analysis and patient behavior. It also reduces the temptation to follow market trends blindly. Short-term traders often chase whatever is popular at the moment. They buy because others are buying. They sell because others are selling. But rational investors step away from this crowd behavior. They focus on the long journey of business growth rather than the short excitement of price movements. This does not mean that markets will always move smoothly. Even the strongest businesses experience periods of decline. Economic cycles change. Global events create uncertainty. But history shows that strong companies often recover and continue growing over long periods. Investors who remain patient during difficult moments often benefit the most when conditions improve again. Thinking long-term also encourages investors to ignore unnecessary distractions. Financial media often focuses on daily events because daily stories attract attention. But rational investors know that most of these stories will be forgotten within a few months. The long-term success of a business is far more important than temporary headlines. By focusing on years instead of days, investors gain clarity. They gain patience. They gain the emotional stability required for rational decisions. Over time, this mindset creates a powerful advantage. While others chase quick profits and react emotionally to every market movement, the rational investor calmly allows compounding to work. Slow progress may not appear exciting at first, but over many years the results can become extraordinary. This is why long-term thinking is the foundation of rational investing. It protects investors from emotional mistakes. It strengthens patience and discipline. And it allows the quiet power of compounding to transform steady effort into lasting wealth. But long-term thinking alone is not enough. Even patient investors can make mistakes if they invest in things they do not truly understand. For this reason, the next principle of rational investing focuses on clarity and knowledge. The ability to invest only in businesses that can be clearly understood. This brings us to the next rule of the rational investor. Rule 2. Invest in what you understand. One of the most common mistakes in investing begins with confusion. Many investors buy stocks without truly understanding what the business does. They follow trends. They listen to tips from friends. They react to excitement on television or social media. For a short time, this behavior may appear successful, but eventually confusion leads to fear. When the price falls, the investor begins to panic. They do not understand the business well enough to remain calm. They sell quickly, often at the worst possible moment. Rational investors avoid this problem by following a simple principle. They invest only in businesses they understand clearly. Understanding a business does not require complex mathematics. It requires clarity about how the company makes money. What products does the company sell? Who are its customers? Why do customers choose this company instead of competitors? What advantages protect the business from competition? These questions create the foundation of intelligent investing. The legendary fund manager Peter Lynch once said that investors should never invest in a business they cannot understand. This idea may sound obvious, yet it is ignored very often. During periods of excitement, investors rush into industries they barely understand. Technology booms, new financial products, or fashionable trends attract large crowds. Many investors buy simply because prices are rising, but price movement does not equal understanding. Without understanding, investors become prisoners of market emotion. When prices rise, they feel confident. When prices fall, they feel afraid. But when investors truly understand a business, their behavior becomes different. They know how the company earns revenue. They know what drives long-term growth. They know what risks the company faces. This knowledge creates patience. Imagine owning a small bakery in your neighborhood. You understand the business clearly. You know the customers. You see how sales change during different seasons. You understand the costs and the profits. If the value of your bakery suddenly dropped for a short period, you would not panic immediately. You would examine the real situation calmly. You would ask whether the business itself had changed or whether the change was temporary. This is exactly how rational investors approach the stock market. When they buy shares in a company, they imagine themselves as partial owners of the business. Ownership thinking creates responsibility and clarity. Instead of watching prices constantly, they observe the strength of the business itself. The great investor Warren Buffett has often explained that investors should stay within their circle of competence. The circle of competence represents the areas of knowledge that an investor understands well. Some people understand banking businesses. Some understand technology companies. Others understand consumer products or manufacturing industries. There is no need to understand every industry in the world. What matters is recognizing where your understanding is strong and where it is weak. Rational investors remain disciplined inside their circle of competence. They are comfortable saying that they do not understand a particular company. This honesty protects them from costly mistakes. Another advantage of understanding businesses is the ability to think independently. When investors lack knowledge, they depend on the opinions of others. They follow analysts, commentators, and popular trends, but investors who truly understand a company can evaluate information more confidently. They can decide whether new developments are important or temporary. This independence creates emotional stability. When markets become volatile, investors with knowledge remain calm. They know that temporary price changes do not always reflect the true strength of a business. This mindset allows them to act rationally while others panic. Understanding also improves the quality of long-term decisions. Investors who understand their investments are more likely to hold strong companies for many years. They recognize the gradual progress of the business. They see improvements in products, customer loyalty, and competitive strength. These developments often lead to long-term value creation. Another important benefit of understanding is the ability to recognize risk. Every business faces challenges. Competition increases. Consumer preferences change. Economic conditions shift over time. Investors who understand the business can recognize these risks early. They can evaluate whether the company is capable of adapting and surviving. Without understanding, investors may ignore warning signs until it is too late. This is why rational investing always begins with learning. Before buying a stock, the investor asks simple but powerful questions. How does this business earn money? Why do customers choose it? What advantages protect it from competitors? What could weaken the company in the future? These questions transform investing from guessing into analysis. Knowledge replaces speculation. Clarity replaces confusion. Over time, this disciplined approach creates stronger and more confident investors. But even when investors understand businesses well, another challenge still exists. The modern world produces endless streams of financial information. News headlines appear every hour. Market predictions fill television screens and online platforms. Many investors become overwhelmed by this constant flow of information. This creates distraction and emotional reactions. Rational investors must therefore learn another essential skill: the ability to ignore unnecessary noise and focus only on what truly matters. This leads us to the next principle of rational investing. Rule 3. Ignore the noise. Modern investors live in a world filled with constant information. Every day, thousands of headlines appear about the market. Financial television debates what stocks will rise tomorrow. Experts publish predictions about interest rates, economic growth, and market crashes. Social media spreads opinions at incredible speed. This endless flow of information creates a powerful illusion. It makes investors believe that they must always react quickly. It makes them feel that every new piece of information is important. But in reality, most of this information is simply noise. Noise is information that attracts attention but does not help long-term decision-making. Rational investors understand this difference. They know that successful investing rarely depends on reacting to daily news. It depends on understanding businesses and allowing time for value to grow. The famous investor Warren Buffett once explained that investors should not focus on what the market will do tomorrow or next week. Instead, they should focus on the long-term performance of businesses. Daily market news often creates emotional pressure. When investors see dramatic headlines about market declines, fear appears quickly. When they see stories about rapid gains, excitement begins to grow. Both emotions push investors toward unnecessary actions. Fear causes them to sell too early. Excitement causes them to buy too late. This cycle repeats again and again in financial markets. Rational investors break this cycle by learning to ignore noise. They recognize that markets move every day for many complex reasons. Political events change expectations. Economic data surprises analysts. Large institutions move capital between different investments. These movements often have little connection to the long-term value of a business. The great value investor Benjamin Graham described the market as a partner who offers prices every day. Sometimes this partner is optimistic. Sometimes he is depressed. But the intelligent investor does not follow the partner's mood. Instead, the investor decides whether the offered price makes sense based on the true value of the business. This idea helps investors separate price from value. Noise usually affects price in the short term, but real value changes slowly over time. Understanding this difference allows rational investors to remain calm while others panic. Another reason noise is dangerous is that it encourages constant activity. Many investors believe they must always be doing something. They buy and sell frequently because they feel pressure to respond to new information. But activity does not always lead to progress. The wise investor Charlie Munger often reminds investors that the big money is not in the buying and selling, but in the waiting. Waiting may appear inactive, but it is often the most intelligent action. When investors own strong businesses, patience allows the company to grow and compound value over time. Constant reactions to noise interrupt this process. Another problem created by noise is confusion. Different experts often present completely opposite opinions. One analyst predicts rapid economic growth. Another warns about recession. One commentator expects a market boom. Another predicts a market crash. When investors try to follow all these opinions, clarity disappears. Rational investors solve this problem by focusing on a smaller number of reliable factors. They study business fundamentals. They analyze company earnings and competitive advantages. They observe long-term trends rather than daily fluctuations. This focused approach protects them from distraction. It also creates a calm mental environment where rational thinking becomes possible. Ignoring noise does not mean ignoring reality. Important changes in a business must always be studied carefully. If a company loses its competitive advantage or management makes poor decisions, investors must pay attention. But these events are rare compared to the daily flood of financial headlines. Rational investors learn to distinguish between meaningful information and temporary excitement. They give their attention only to facts that truly affect long-term value. This discipline creates a powerful advantage. While many investors react emotionally to every headline, rational investors remain calm and focused. They allow time to work in their favor. They protect themselves from unnecessary mistakes. Over many years, this simple habit of ignoring noise can dramatically improve investment results. But even when investors ignore noise and focus on long-term value, another challenge still remains. Human emotions are powerful forces. Fear and greed can influence decisions even when investors understand the correct principles. For this reason, rational investing requires more than knowledge. It requires emotional discipline, the ability to remain calm when markets become uncertain. This leads us to the next rule of the rational investor. Rule 4. Control your emotions. Financial markets are not driven only by numbers and analysis. They are also driven by human emotions. Fear and greed appear again and again throughout the history of investing. These emotions influence decisions far more than many investors realize. When prices rise quickly, excitement spreads through the market. Investors begin to believe that prices will continue rising forever. They rush to buy without careful analysis. When prices fall sharply, the opposite happens. Fear spreads rapidly. Investors begin to believe that the decline will never end. They sell their investments quickly, often at very low prices. This cycle of excitement and fear has repeated many times across history. Rational investors understand that emotions are natural. Every human being experiences fear and excitement. But successful investors learn how to prevent these emotions from controlling their decisions. The legendary investor Benjamin Graham explained that the greatest challenge in investing is not the market itself. The greatest challenge is the investor's own behavior. Many intelligent people fail in investing because they cannot control their emotions during stressful moments. Rational investors therefore develop habits that protect emotional discipline. One of the most important habits is preparation. Before making an investment decision, rational investors carefully analyze the business. They study its earnings, products, and long-term potential. When this research is complete, they form a clear reason for owning the investment. This preparation becomes extremely valuable when market prices begin to fluctuate. If the price of a stock suddenly falls, the rational investor does not panic immediately. Instead, they ask a simple question: has the business itself changed, or has the market simply become emotional? If the business remains strong, the decline may represent an opportunity rather than a disaster. The famous investor Warren Buffett often explains that investors should remain calm when others panic. He famously advised investors to be fearful when others are greedy, and greedy when others are fearful. This idea highlights the importance of emotional control. Crowds tend to behave emotionally. Rational investors behave thoughtfully. Another helpful mindset comes from ancient philosophy. The Roman thinker Seneca believed that true strength comes from controlling emotional reactions. This philosophy fits perfectly with rational investing. Markets will always experience uncertainty. Unexpected events will always occur. But investors who maintain calm thinking during difficult moments often make better decisions than those who react emotionally. Emotional discipline also protects investors from chasing trends. When a particular industry becomes popular, many investors rush into it without careful analysis. They fear missing the opportunity. This fear is often called the fear of missing out. But trends driven by excitement can reverse suddenly. Investors who buy at the peak of excitement often suffer the greatest losses when reality returns. Rational investors avoid this trap by slowing down their decisions. Instead of reacting immediately, they step back and analyze the situation carefully. They ask whether the investment truly offers long-term value or whether the excitement is temporary. Another benefit of emotional control is patience. When investors remain calm, they can hold strong businesses for many years without unnecessary trading. This patience allows the power of compounding to work effectively. Constant emotional reactions interrupt this process. The wise investor Charlie Munger often emphasized that temperament is more important than intelligence in investing. In other words, the ability to stay calm and rational often matters more than complex financial knowledge. Over time, emotional discipline becomes a powerful advantage. Markets will always experience moments of panic and excitement. Crowds will continue to react emotionally. But investors who control their emotions can remain focused on long-term value. They avoid selling during temporary declines. They avoid buying during moments of extreme excitement. Instead, they follow rational principles with patience and discipline. This mindset protects them from the most common mistakes that destroy wealth. But controlling emotions is only one part of rational investing. Investors must also learn to distinguish between the price of a stock and the true value of the business behind it. Many investors confuse these two ideas. They assume that a rising price means increasing value. But rational investors know that price and value are not always the same. Understanding this difference is one of the most powerful ideas in investing. This leads us to the next rule of the rational investor. Rule 5. Focus on value, not price. One of the most important ideas in rational investing is understanding the difference between price and value. Many investors look only at the price of a stock. They watch charts move up and down. They celebrate when prices rise and worry when prices fall. But price alone does not tell the true story of an investment. Price simply shows what people are willing to pay at a particular moment. Value represents the real worth of the business behind that price. These two things are not always the same. In fact, they can be very different for long periods of time. The great teacher of value investing. Benjamin Graham explained that the stock market often behaves like a very emotional partner. Some days this partner becomes extremely optimistic and offers very high prices. Other days the partner becomes depressed and offers very low prices. But the intelligent investor does not allow these emotional moods to determine decisions. Instead, the rational investor focuses on the real value of the business. Value comes from the strength of the company itself. It comes from the products the company sells. It comes from loyal customers who continue buying those products. It comes from strong management decisions and the ability to grow over time. When these factors improve, the real value of the business increases even if the market price does not immediately reflect it. Rational investors therefore ask a different set of questions than most people. Instead of asking whether a stock price will rise tomorrow, they ask whether the business itself is becoming stronger. They examine company earnings. They study revenue growth. They analyze competitive advantages that protect the business from rivals. This type of thinking transforms investing from speculation into ownership. The famous investor Warren Buffett often reminds investors that when they buy a stock, they are buying a small piece of a real business. This perspective changes how investors interpret market prices. If the market offers a low price for a strong business, the rational investor may see an opportunity. If the market offers a very high price for a weak business, the rational investor becomes cautious. In other words, price becomes useful information rather than a command to act emotionally. Another reason price can be misleading is short-term market sentiment. Markets react quickly to news, rumors, and economic events. Prices can rise or fall dramatically within a short period. But the real value of a business rarely changes so quickly. Factories do not disappear overnight. Customer relationships do not vanish instantly. Strong brands built over decades do not suddenly lose all their value in a single day. Because of this difference between price movement and real value, patient investors often discover opportunities during moments of market pessimism. When fear spreads across the market, many investors rush to sell. Prices may fall sharply, even though the long-term business outlook remains stable. Rational investors who focus on value rather than price can recognize these situations more clearly. They understand that a lower price can sometimes mean a better investment. However, focusing on value also requires caution. A low price does not always mean a good opportunity. Sometimes a price is low because the business itself is weakening. This is why careful analysis is always necessary. Rational investors examine whether the company still has strong fundamentals. They study whether its competitive advantages remain intact. If the business continues to create value, a temporary price decline may represent opportunity rather than danger. Another advantage of focusing on value is emotional stability. Investors who concentrate only on price movements experience constant stress. Daily fluctuations feel like victories or disasters. But investors who focus on business value develop a calmer mindset. They understand that short-term price changes are often temporary. What truly matters is the long-term performance of the company. Over time, strong businesses tend to reflect their real value in the market price. This may take months or even years, but eventually, value and price move closer together. This idea forms the foundation of rational investing. By focusing on value rather than price, investors avoid many of the emotional traps that dominate financial markets. They become patient owners instead of nervous traders. This discipline helps them identify genuine opportunities and avoid overpriced excitement. But even careful analysis of value cannot eliminate uncertainty completely. Unexpected events can always affect businesses and markets. Because of this uncertainty, rational investors follow another powerful principle that protects them from mistakes: the principle of buying with a margin of safety. This leads us to the next rule of the rational investor. Rule 6. Demand a margin of safety. Even the most careful investor can make mistakes. The future is uncertain. Economic conditions change. Competition increases. Unexpected events appear without warning. Because of this uncertainty, rational investors never rely on perfect predictions. Instead, they protect themselves by following an important principle known as the margin of safety. This idea was strongly emphasized by the father of value investing, Benjamin Graham. The margin of safety means buying an investment only when the price is significantly below its estimated value. This difference between value and price acts like a protective cushion. If the investor's analysis turns out to be slightly wrong, the margin of safety reduces the risk of large losses. To understand this idea more clearly, imagine building a bridge. Engineers do not design a bridge to support exactly the weight expected on it. They build the bridge strong enough to support far more weight than necessary. This extra strength protects the bridge from unexpected stress. The margin of safety works in a similar way for investors. Instead of paying the full estimated value of a company, rational investors prefer to buy when the price is comfortably lower. This protection is extremely valuable because no investor can predict the future perfectly. Even experienced professionals make errors in judgment. Company earnings may grow slower than expected. Management decisions may disappoint investors. Economic conditions may change suddenly. When investors pay too high a price, even a small mistake can lead to significant losses. But when investors buy with a margin of safety, they reduce this risk. The great investor Warren Buffett often emphasizes the importance of avoiding permanent losses. He believes that protecting capital is the first responsibility of an investor. Profits become possible only after capital is protected. The margin of safety supports this philosophy. It forces investors to remain disciplined about price. Instead of chasing exciting opportunities, rational investors wait patiently for situations where price offers clear value. This patience is difficult for many people. Markets often create excitement when prices rise quickly. Investors begin to fear missing opportunities. They rush to buy without considering whether the price is reasonable, but rational investors resist this pressure. They understand that paying too much for even a good business can lead to disappointing results. Price always matters. A wonderful business purchased at an extremely high price can become a poor investment. But a strong business purchased at a reasonable price with a margin of safety offers both opportunity and protection. Another advantage of the margin of safety is emotional comfort. When investors buy with a large cushion between price and value, they feel less pressure from short-term market movements. Temporary price declines become easier to tolerate because the investment was purchased with protection already built in. This allows rational investors to remain calm while others panic. Markets often experience periods of pessimism when prices fall sharply. During these moments, many investors sell in fear, but rational investors who have studied value carefully may recognize opportunity. They understand that strong businesses can temporarily trade at very low prices when fear dominates the market. The patient investor who demands a margin of safety is prepared for these moments. Instead of reacting emotionally, they evaluate whether the decline has created a favorable opportunity. This approach transforms market volatility from a threat into a potential advantage. However, finding a margin of safety requires discipline and patience. Such opportunities do not appear every day. Sometimes investors must wait for long periods without making new investments, but waiting is often a sign of wisdom rather than weakness. The intelligent investor understands that protecting capital is more important than constant activity. By insisting on a margin of safety, rational investors protect themselves from uncertainty, reduce the risk of large mistakes, and create opportunities for long-term success. This principle acts as a shield against the unpredictable nature of financial markets. Yet even when investors choose strong businesses and buy with a margin of safety, another important principle must still be considered. No single investment is completely free from risk. Unexpected problems can affect even the strongest companies. For this reason, rational investors follow another rule that helps protect their capital over time: the rule of thoughtful diversification. This leads us to the next principle of the rational investor. Rule 7. Diversify wisely. No matter how careful an investor may be, uncertainty can never be completely removed from investing. Businesses face competition. Technologies change. Consumer preferences evolve. Economic conditions rise and fall over time. Because of these uncertainties, rational investors understand that placing all their money in a single investment can be dangerous. Even a well-researched company can face unexpected difficulties. Diversification helps reduce this risk. Diversification simply means spreading investments across different businesses, industries, or assets instead of concentrating everything in one place. By doing this, the investor reduces the damage that could occur if one investment performs poorly. This idea has been widely accepted by many successful investors and economists. The economist Harry Markowitz, who helped develop modern portfolio theory, famously described diversification as the only free lunch in investing. His idea was simple but powerful. When investors combine different investments that behave differently over time, the overall risk of the portfolio can be reduced. Rational investors understand this benefit clearly. Instead of depending entirely on one company or one industry, they spread their investments across multiple opportunities. If one business experiences difficulties, the impact on the entire portfolio becomes smaller. However, rational diversification is not the same as random diversification. Some investors misunderstand this concept and buy too many investments without careful analysis. Owning dozens of companies that are poorly understood does not create safety. It can actually create confusion. Rational investors prefer thoughtful diversification. They choose a limited number of strong businesses that they understand well. These businesses may operate in different industries or serve different types of customers. This balanced approach reduces risk while maintaining clarity. The legendary investor Warren Buffett has often explained that diversification is useful especially for investors who are not able to study companies deeply. For such investors, spreading investments broadly can protect them from large mistakes. However, investors who understand businesses very well may choose to concentrate slightly more on their best ideas while still maintaining reasonable diversification. The key idea is balance. Too little diversification increases risk because a single mistake can damage the entire portfolio. Too much diversification can reduce potential returns and make it difficult to monitor each investment carefully. Rational investors therefore seek a thoughtful middle path. They hold enough investments to reduce risk, but not so many that they lose focus. Another advantage of diversification is emotional stability. When investors hold only one or two investments, every price movement becomes extremely stressful. If the price of that single investment falls sharply, fear can quickly dominate decision-making. But when investors hold a diversified portfolio, the impact of a single decline becomes smaller. This balance helps investors remain calm during market volatility. Diversification also encourages long-term thinking. Different industries perform well at different times. Technology companies may grow rapidly during certain periods. Energy companies may perform better during other economic cycles. A diversified portfolio allows investors to participate in multiple areas of the economy. This approach reduces dependence on predicting which sector will perform best in the near future. Instead of trying to predict short-term trends, rational investors focus on building a resilient portfolio capable of surviving many different economic conditions. Over long periods, this resilience becomes extremely valuable. Economic environments change repeatedly throughout history. Periods of growth are followed by recessions. Innovation creates new industries while older industries transform. Investors who maintain diversification are better prepared to navigate these changes. However, diversification does not eliminate risk entirely. Markets will still experience volatility. Individual companies will still face challenges. But diversification reduces the probability that a single mistake will destroy long-term progress. It acts as a protective structure supporting the entire investment portfolio. When combined with careful analysis and patience, diversification strengthens the foundation of rational investing. But even with a diversified portfolio, success in investing still requires one powerful quality that many investors struggle to develop: the ability to wait patiently while investments grow over time. This patience may appear simple, but in practice it is one of the rarest qualities in financial markets. This brings us to the next rule of the rational investor. Rule 8. Patience is a superpower. In the world of investing, patience often separates successful investors from unsuccessful ones. Many people enter the market hoping for quick profits. They expect investments to grow rapidly within weeks or months. When results do not appear immediately, they become impatient. This impatience often leads to unnecessary decisions. Investors sell too early, so they move money from one investment to another. They chase new opportunities that promise faster results. But rational investors understand a different truth. Wealth in the market usually grows slowly. Strong businesses require time to expand. They develop new products. They improve operations. They build customer loyalty and strengthen their competitive advantages. These processes rarely happen overnight. Investors who expect instant results often abandon good investments before the real benefits appear. Rational investors approach the market with a longer perspective. They understand that patience allows the power of compounding to work. Compounding occurs when investment returns begin to generate their own returns. Over time, this process creates a powerful cycle of growth. The scientist Albert Einstein is often associated with a famous observation that compound growth is one of the most powerful forces in the universe. Whether spoken exactly in those words or not, the idea captures an important truth about investing. Small gains repeated over many years can grow into extraordinary wealth. But this transformation requires time. Many investors interrupt this process because they cannot remain patient. They react to short-term price movements. They become worried when the market declines temporarily. They sell investments that still have strong, long-term potential. Rational investors resist this pressure. They understand that market volatility is normal. Prices rise and fall regularly. But temporary price movements do not always reflect the long-term strength of a business. The famous investor Warren Buffett has often explained that the stock market is designed to transfer money from the impatient to the patient. This simple idea contains deep wisdom. When impatient investors react emotionally to market fluctuations, they often sell their investments prematurely. Patient investors who remain calm during these moments are often the ones who benefit later. Patience also allows investors to focus on the true drivers of long-term success. Instead of watching daily price movements, rational investors observe business progress. They examine whether the company continues to grow revenue. They observe whether the company maintains strong competitive advantages. They evaluate whether management continues to make intelligent decisions. When these fundamentals remain strong, patient investors often choose to hold their investments for many years. Another important benefit of patience is reduced trading. Frequent trading creates costs. Transaction fees reduce overall returns. Taxes on short-term gains can also reduce profits. Patient investors avoid many of these costs by holding investments for longer periods. This allows more capital to remain invested and continue compounding. Patience also protects investors from emotional decision-making. When investors constantly monitor short-term price movements, they often experience stress and anxiety. But investors who adopt a long-term perspective can remain calmer during market fluctuations. They understand that short-term volatility is part of the investing journey. The wise investor Charlie Munger often emphasized that great investing requires the ability to wait. He explained that the big money is not made in constant buying and selling. It is made in waiting while good investments grow over time. Waiting may appear inactive, but in reality it requires strong discipline. The temptation to act is always present in financial markets. New opportunities appear constantly. Predictions about market movements fill financial media every day. But rational investors recognize that action is not always necessary. Sometimes the most intelligent decision is simply to do nothing and allow time to work. Over many years, patience becomes a powerful advantage. While impatient investors chase trends and react to every market movement, patient investors quietly allow their investments to grow. Compounding gradually transforms steady progress into meaningful wealth. This is why patience can truly be described as a superpower in investing. However, patience must be combined with thoughtful behavior. Even patient investors can harm their results if they trade too frequently or react unnecessarily to short-term changes. To protect the power of patience, rational investors follow another important rule. They avoid constant trading and unnecessary activity in the market. This leads us to the next principle of the rational investor. Rule 9. Avoid constant trading. Many investors believe that success in the market requires constant activity. They watch prices every day. They buy and sell frequently. They react to every small movement in the market. This behavior creates the feeling of being productive. It feels as if the investor is always doing something important, but in reality, constant trading often damages investment results. Every trade introduces costs. Brokerage fees reduce returns. Taxes on short-term gains take another portion of profits. Over time, these small costs accumulate and reduce the power of compounding. Rational investors understand that activity does not always lead to progress. In many cases, the best investment decision is patience rather than action. The legendary investor Warren Buffett has often explained that the stock market rewards those who can remain patient. He once described his preferred holding period as forever. This idea does not mean that investors should never sell, but it emphasizes the value of long-term ownership. When investors buy shares in strong businesses, frequent trading interrupts the natural process of value creation. Businesses grow gradually. They expand their products and services. They attract new customers and strengthen their competitive advantages. These developments take time to appear in the market price. Investors who trade constantly rarely allow enough time for this growth to unfold. Another problem with frequent trading is emotional pressure. When investors monitor prices constantly, they experience a continuous cycle of excitement and fear. A small price increase creates excitement. A small decline creates anxiety. These emotional reactions encourage investors to act quickly rather than think carefully. Rational investors step away from this cycle. They focus on business fundamentals rather than daily price movements. If the underlying business continues to perform well, there is often little reason to trade frequently. The wise investor Charlie Munger often explained that the big money in investing is not made in the buying or selling. It is made in the waiting. Waiting allows businesses to grow and compound value over time. Frequent trading interrupts this process and turns investing into speculation. Another important danger of constant trading is the illusion of control. When investors trade frequently, they may begin to believe they can predict short-term market movements. But the truth is that short-term price changes are extremely difficult to predict consistently. Even professional investors with advanced tools struggle to forecast daily market behavior. Rational investors accept this reality. Instead of attempting to predict every short-term movement, they concentrate on identifying strong businesses with long-term potential. Once such investments are made, they allow time for value to develop. Reducing trading also encourages deeper thinking. When investors know they cannot trade constantly, they become more careful before making a purchase. They study the company more thoroughly. They evaluate risks more carefully. They think about the long-term prospects of the business. This disciplined approach improves the quality of investment decisions. Another advantage of limited trading is lower stress. Constant market activity can create mental exhaustion. Investors feel pressure to react quickly to every new piece of information, but investors who trade less often experience a calmer investment process. They observe their investments periodically rather than obsessively. They remain focused on long-term goals instead of daily fluctuations. This calmer approach allows rational thinking to guide decisions. Over time, avoiding constant trading can significantly improve investment performance. Lower costs, reduced emotional pressure, and greater patience all contribute to better long-term results. However, even disciplined investors will occasionally make mistakes. Some investments will perform worse than expected. Certain decisions will turn out to be incorrect. These moments are inevitable in the journey of investing. The difference between successful and unsuccessful investors lies in how they respond to these mistakes. Rational investors do not ignore their errors. Instead, they study them carefully and learn valuable lessons. This leads us to the next rule of the rational investor. Rule 10. Learn from mistakes. Every investor will make mistakes. This truth applies to beginners as well as experienced professionals. No strategy can eliminate errors completely because the future always contains uncertainty. Markets change. Businesses evolve. Unexpected events influence the economy. Because of this uncertainty, mistakes are not a sign of failure. They are part of the learning process. What truly matters is how investors respond to those mistakes. Unsuccessful investors often try to ignore their errors. They blame bad luck or unexpected market conditions. They move quickly to the next investment without reflecting on what went wrong. This behavior prevents learning. Rational investors behave differently. When an investment decision turns out poorly, they pause and analyze the situation carefully. They ask important questions. Did I misunderstand the business? Did I overestimate the company's competitive advantage? Did I pay too high a price for the investment? Did emotions influence my decision? These questions transform mistakes into valuable lessons. The legendary investor Warren Buffett has often admitted that he has made many mistakes throughout his long investing career. Some of those mistakes involved buying businesses that later performed poorly. Others involved failing to invest in great companies early enough. Yet these experiences did not destroy his success. Instead, they helped him refine his thinking and improve his decision-making over time. Another great investor, Charlie Munger, often emphasizes the importance of learning from errors. He once explained that wise people learn not only from their own mistakes, but also from the mistakes of others. This mindset creates continuous improvement. Instead of repeating the same errors, rational investors gradually strengthen their judgment. One useful habit is keeping a record of investment decisions. When investors write down the reasons for buying a particular company, they create a clear reference for future learning. Later, they can compare the original expectations with the actual results. This comparison reveals whether the analysis was correct or flawed. Over time, this process sharpens the investor's ability to recognize strong opportunities and avoid weak ones. Learning from mistakes also encourages humility. Financial markets have a way of reminding investors that certainty is impossible. Even the most experienced analysts can misjudge a company's future. Recognizing this reality prevents overconfidence. Humility keeps investors open to new information and willing to adjust their thinking. The economist John Maynard Keynes once expressed this idea clearly. He said that when the facts change, he changes his mind. This flexibility is an important part of rational investing. When new evidence shows that an investment thesis is incorrect, rational investors do not stubbornly defend their earlier decisions. They accept the new information and adapt their strategy. Another valuable lesson from mistakes is the importance of risk awareness. Sometimes investors lose money not because the business was weak, but because they took excessive risk. They may have concentrated too much capital in a single investment. They may have purchased a company at an unrealistic price. Analyzing these errors helps investors design better rules for the future. Over time, the investor's process becomes stronger and more disciplined. Mistakes also teach emotional resilience. Losses can be painful experiences. They can create disappointment and self-doubt. But rational investors treat these experiences as opportunities for growth rather than reasons for discouragement. They understand that every experienced investor has faced periods of difficulty. What matters is maintaining a long-term perspective. By studying mistakes honestly and calmly, investors convert temporary setbacks into valuable knowledge. This knowledge compounds just like financial capital. Each lesson improves future decisions. Each improvement strengthens the investment process. Gradually, the investor develops deeper understanding and greater confidence. Another powerful benefit of learning from mistakes is independence of thought. When investors carefully analyze their own decisions, They rely less on outside opinions. They develop their own judgment based on experience and study. This independence helps them resist the influence of market crowds and popular trends. Instead of blindly following the opinions of others, rational investors evaluate opportunities using their own reasoning. Over many years, this habit becomes one of the strongest advantages an investor can possess. Mistakes, therefore, serve an important purpose. They reveal weaknesses in thinking. They highlight gaps in knowledge. They encourage continuous learning. When approached with humility and curiosity, mistakes become powerful teachers. But learning from mistakes also leads to another important realization. Financial markets are heavily influenced by crowd behavior. Large groups of investors often move in the same direction at the same time. They follow trends and react emotionally to news and price movements. Rational investors must learn to step away from this crowd mentality. They must develop the ability to think independently and evaluate opportunities using their own reasoning. This independence protects them from many of the mistakes that occur when people simply follow the crowd. This brings us to the next rule of the rational investor. Rule 11. Think independently. Financial markets are deeply influenced by crowd behavior. Large groups of investors often move together in the same direction. When prices rise, excitement spreads quickly and more people rush to buy. When prices fall, fear spreads just as rapidly, and many investors rush to sell. This pattern has repeated many times throughout the history of markets. Human beings naturally feel comfortable following the crowd. When everyone around us believes something, it feels safer to believe the same thing. But in investing, following the crowd often leads to poor results. Crowds tend to become overly optimistic during market booms. They push prices far above the real value of businesses. Later, during market declines, the same crowds may become overly pessimistic. Fear pushes prices far below reasonable value. Rational investors understand that crowd emotions create both danger and opportunity. To navigate these situations successfully, they develop the ability to think independently. Independent thinking means evaluating investments using careful analysis rather than popular opinion. Instead of asking what everyone else is doing, rational investors ask a different question. What does the evidence suggest about the true value of this business? This approach requires discipline. It can feel uncomfortable to disagree with the majority. It can also feel difficult to remain patient when others appear to be making quick profits. But independence is often the key to long-term success. The legendary investor Warren Buffett expressed this idea clearly when he advised investors to be fearful when others are greedy and greedy when others are fearful. This statement highlights the importance of resisting crowd emotions. When investors become overly excited about a particular opportunity, prices may rise far beyond reasonable levels. Rational investors observe this situation carefully and often choose patience instead of participation. Later, when fear dominates the market and prices decline sharply, independent thinkers may recognize opportunities that others overlook. Independent thinking does not mean ignoring all outside information. Financial markets contain valuable data and insights from many sources. But rational investors evaluate this information critically rather than accepting it blindly. They examine the facts carefully. They consider different perspectives. They test whether the arguments make logical sense. This thoughtful evaluation protects them from the influence of popular trends and emotional predictions. Another advantage of independent thinking is clarity of purpose. When investors rely heavily on the opinions of others, they often become confused by conflicting advice. One expert recommends buying, another recommends selling, a third predicts a major market decline. Trying to follow all these opinions creates uncertainty and stress. Independent investors avoid this confusion by developing their own investment principles. These principles guide their decisions even when public opinion changes rapidly. The wise investor Charlie Munger often emphasized that rational thinking requires the courage to stand apart from the crowd. He believed that clear thinking is more important than popularity in financial markets. In other words, the goal of investing is not to agree with the majority. The goal is to be correct about value and opportunity. Independent thinking also protects investors from speculative bubbles. Throughout history, there have been moments when certain assets became extremely popular. Prices rose rapidly as more and more investors rushed to participate. During these periods, it can feel difficult to remain cautious. But rational investors remember that price increases alone do not guarantee long-term value. They examine whether the underlying business justifies the rising price. If the price becomes disconnected from reality, independent investors are willing to step aside even while others continue buying. Another benefit of independent thinking is emotional stability. Investors who constantly follow the crowd often experience extreme emotional swings. When the crowd becomes optimistic, they feel excited. When the crowd becomes fearful, they feel anxious. But independent investors rely on their own analysis rather than the emotional mood of the market. This mindset allows them to remain calm during both booms and declines. Over time, independent thinking becomes one of the greatest strengths an investor can develop. It encourages rational analysis instead of emotional reaction. It protects investors from the mistakes of herd behavior. It allows them to recognize opportunities that others may ignore. However, independent thinking must also be balanced with caution. Even the most thoughtful analysis cannot eliminate all risk. For this reason, rational investors follow another important rule that guides every investment decision. Before thinking about profits, they focus on protecting their capital. This leads us to the next principle of the rational investor. Rule 12. Protect capital first. Many people enter the world of investing with one primary goal. They want to make money quickly. This desire is understandable. After all, the purpose of investing is to grow wealth over time. But rational investors approach this goal in a different way. Instead of focusing first on profits, they focus first on protection. Protecting capital is the foundation of long-term investing success. Capital represents the resources that investors place into the market. It is the starting point from which all future growth must occur. If this capital is lost through large mistakes, the ability to benefit from future opportunities becomes much smaller. For this reason, rational investors always think about risk before thinking about return. The legendary investor Warren Buffett once summarized this idea with two famous rules. Rule 1 is never lose money. Rule 2 is never forget Rule 1. Although these words may sound simple, they carry deep meaning. Buffett did not mean that investors will never experience temporary declines. Market prices move up and down regularly, but he emphasized the importance of avoiding permanent losses that destroy capital. Rational investors therefore develop habits that protect their financial resources. One of these habits is careful research. Before investing in a company, rational investors study the business carefully. They examine how the company earns money. They evaluate the strength of its competitive advantages. They consider the long-term demand for its products and services. This research reduces the chance of investing in weak or declining businesses. Another important habit is buying at reasonable prices. Even strong businesses can become risky investments if their prices rise too high. When investors pay excessive prices, the potential for future disappointment increases. By maintaining discipline about price, rational investors reduce the probability of permanent losses. This idea connects closely with the principle of margin of safety taught by Benjamin Graham. Buying with a margin of safety provides protection against unexpected events or errors in analysis. Diversification also plays a role in protecting capital. By spreading investments across multiple businesses or industries, investors reduce the damage that any single mistake can cause. If one investment performs poorly, other investments in the portfolio can help balance the overall result. Protection also requires emotional discipline. Fear and excitement often push investors into risky decisions. During periods of market excitement, investors may chase rapidly rising prices. They fear missing the opportunity and ignore the risks involved. Later, when prices decline sharply, panic may cause them to sell their investments at the worst possible moment. Rational investors avoid these emotional reactions by maintaining a long-term perspective. They recognize that markets move in cycles. Periods of optimism are followed by periods of pessimism. By remaining calm during these cycles, investors protect themselves from costly emotional mistakes. Another important aspect of protecting capital is avoiding excessive complexity. Some financial products promise high returns, but involve complicated structures and hidden risks. Rational investors prefer simplicity. They focus on businesses they understand clearly and investments that have transparent characteristics. Clarity reduces the chance of unpleasant surprises. Protecting capital also requires patience. Opportunities that offer both value and safety may not appear every day. Rational investors are willing to wait until favorable conditions arise. Instead of forcing investments in uncertain situations, they preserve their capital for better opportunities in the future. This patience strengthens long-term results. Over time, the habit of protecting capital creates stability in the investment journey. Large losses become rare. The portfolio grows steadily through careful decisions. This stability allows investors to benefit from the power of compounding. When capital is preserved and reinvested wisely, growth can continue year after year. In contrast, investors who experience large losses must work much harder to recover. For example, losing half of an investment requires doubling the remaining capital just to return to the starting point. Avoiding such severe losses is therefore essential for long-term success. This is why rational investors treat capital protection as a guiding principle rather than an afterthought. Before making any investment decision, they ask an important question. What could go wrong? By considering risks carefully, they reduce the likelihood of unpleasant surprises. Over many years, this cautious approach builds both financial strength and confidence. However, protecting capital and thinking independently also require another important quality. Investors must remain humble about what they truly know and what remains uncertain. Markets constantly evolve. New information appears. Economic conditions change. Rational investors must therefore stay open to learning and avoid becoming overconfident. This brings us to the next rule of the rational investor. Rule 13. Stay humble. Financial markets have a powerful way of teaching humility. No matter how intelligent or experienced an investor may be, certainty is never guaranteed. Businesses change. Industries evolve. Unexpected events influence the global economy. Because of this constant uncertainty, rational investors understand the importance of humility. Humility means recognizing the limits of one's knowledge. It means accepting that mistakes are always possible. It means remaining open to learning and new information. Overconfidence is one of the most dangerous attitudes in investing. When investors become too confident, they may begin to believe that their judgments are always correct. They may ignore warning signs. They may take excessive risks. They may stop questioning their own assumptions. These behaviors often lead to costly mistakes. Rational investors avoid this trap by maintaining a humble mindset. They remind themselves that even the most successful investors have made significant errors during their careers. The legendary investor Warren Buffett has openly discussed many investment mistakes throughout his life. Some of those mistakes involved purchasing businesses that later performed poorly. Others involved missing opportunities that later became extremely successful companies. Despite his extraordinary achievements, Buffett has continued to emphasize the importance of learning and self-reflection. This attitude demonstrates true humility. Another respected investor, Charlie Munger, often advised investors to constantly update their understanding as new information appears. He believed that wise investors must be willing to change their minds when evidence proves them wrong. This ability to adapt requires intellectual humility. The economist John Maynard Keynes once expressed a similar idea when he said that when the facts change, he changes his mind. Rational investors follow this principle closely. They do not cling stubbornly to outdated beliefs. They evaluate new evidence carefully and adjust their thinking when necessary. Humility also encourages continuous learning. Financial markets are complex systems influenced by economics, technology, politics, and human behavior. No investor can understand every aspect perfectly. But humble investors remain curious. They read books, they study business history. They observe how successful companies build lasting advantages. This habit of lifelong learning gradually strengthens their judgment. Another benefit of humility is improved risk awareness. Investors who recognize their limitations are less likely to take reckless risks. They understand that unexpected outcomes are always possible. This awareness encourages them to maintain diversification, demand margins of safety, and protect their capital carefully. Humility also reduces emotional stress. Investors who believe they must always be right may feel intense pressure when markets behave unpredictably. But investors who accept uncertainty remain calmer during difficult periods. They view temporary setbacks as opportunities to learn rather than personal failures. Over time, this balanced mindset creates emotional stability. Markets will always produce surprises. New technologies will transform industries. Economic conditions will shift in unexpected ways. Humble investors remain prepared for these changes because they never assume complete certainty. They remain flexible and thoughtful in their decisions. Another advantage of humility is the ability to listen to different perspectives. Rational investors study a variety of opinions before making decisions. They consider arguments that support their views as well as arguments that challenge them. This balanced approach reduces the risk of confirmation bias, where investors pay attention only to information that agrees with their existing beliefs. By examining multiple perspectives, humble investors gain a clearer understanding of opportunities and risks. Over many years, humility becomes an important foundation of rational investing. It protects investors from overconfidence. It encourages continuous learning. It strengthens emotional stability during uncertain periods. Combined with discipline and patience, humility helps investors navigate the unpredictable nature of financial markets. However, humility and learning must eventually lead to action. Rational investors do not rely on random decisions. They develop clear systems that guide their investment process. These systems help them remain disciplined even when markets become emotional or unpredictable. This leads us to the next rule of the rational investor. Rule 14. Build a personal system. Successful investing rarely happens through random decisions. Many beginners enter the market without a clear plan. They buy stocks based on tips, headlines, or sudden excitement. Sometimes these decisions work for a short time, but eventually inconsistency leads to mistakes. Rational investors approach investing in a more structured way. They build a personal investment system. A system is a set of clear principles that guide every investment decision. It defines how investors research companies. It determines when they buy. It explains how long they hold investments. It also helps them decide when to sell. A strong system reduces emotional reactions. When markets become volatile, investors who follow a system are less likely to panic or chase excitement. Instead, they return to their established rules and evaluate decisions calmly. The legendary investor Warren Buffett has often explained that successful investing requires discipline and consistency. He follows a clear framework when evaluating companies. He studies the business model carefully. He looks for durable competitive advantages. He evaluates management quality. And he insists on paying a reasonable price. This consistent approach has guided his decisions for many decades. Another respected investor, Charlie Munger, also emphasized the importance of structured thinking. He encouraged investors to develop mental models that help them analyze businesses logically. Mental models are simple frameworks that help investors understand complex situations. For example, an investor may analyze whether a company has strong brand loyalty, cost advantages, or network effects that protect it from competitors. Using these frameworks repeatedly creates a reliable decision-making process. A personal investment system does not need to be complicated. In fact, simplicity often leads to better results. A clear system might include a few essential rules. Only invest in businesses that are easy to understand. Prefer companies with strong competitive advantages. Buy when the price offers a margin of safety. Hold investments for the long term when the business remains strong. These simple guidelines can provide powerful structure for decision-making. Another advantage of a personal system is consistency. Without a system, investors may behave differently in different market conditions. During market booms, they may become overly optimistic. During market declines, they may become fearful and sell too quickly. A well-designed system protects investors from these emotional swings. When markets rise dramatically, the system reminds investors to remain disciplined about valuation. When markets decline sharply, the system encourages calm analysis rather than panic. Over time, this consistency creates stability in the investment process. Another benefit of building a personal system is continuous improvement. As investors gain experience, they can refine their rules based on what they learn. Mistakes reveal weaknesses in the process. Success reveals strengths that can be repeated. Gradually, the system becomes stronger and more effective. The economist John Maynard Keynes once suggested that successful decision-making often requires adapting ideas as new information appears. Rational investors apply this principle to their investment systems. They remain flexible and open to improvement while maintaining the core principles that guide their strategy. Another important aspect of a personal system is discipline. Markets will always present distractions. New trends appear constantly. Exciting opportunities attract attention from investors everywhere. Without a clear system, it is easy to abandon careful thinking and follow popular trends. But investors who rely on a structured process remain focused on their long-term goals. They evaluate opportunities using their established rules rather than emotional impulses. Over many years, this discipline creates a powerful advantage. While others chase trends and react to every market movement, rational investors quietly follow their system. Their decisions become consistent, thoughtful, and aligned with long-term wealth creation. But even the strongest system must be supported by one final principle. Markets will experience many ups and downs during an investor's lifetime. Economic crises will appear unexpectedly. Periods of fear and uncertainty will test every investor's patience. To succeed through these cycles, rational investors must develop the ability to remain committed to their principles over time. This leads us to the final rule of the rational investor. Rule 15. Stay the course. Financial markets are never perfectly calm. Throughout history, markets have experienced many periods of excitement and many periods of fear. Booms are followed by declines. Economic growth is followed by recessions. New industries rise while older industries slowly fade. These cycles are a natural part of economic life. For investors, these changes can create emotional pressure. When markets rise rapidly, excitement spreads everywhere. People talk about easy profits. New investors enter the market hoping to participate in the rapid growth. But when markets fall sharply, the atmosphere changes completely. Fear replaces excitement. Headlines predict economic disaster. Many investors begin to doubt their decisions. During these difficult moments, one principle becomes extremely important. Stay the course. Staying the course means remaining committed to rational investment principles even when markets become uncertain or emotional. Rational investors understand that market fluctuations are temporary, but long-term value creation can continue for many years. The legendary investor Warren Buffett has often explained that investors should not be frightened by market volatility. Instead, they should view market movements as opportunities rather than threats. When strong businesses continue to grow, temporary price declines do not necessarily damage long-term investment success. In fact, declining prices may sometimes create opportunities for disciplined investors to buy valuable companies at attractive prices. However, remaining calm during difficult periods requires discipline and confidence. The wise investor Charlie Munger frequently emphasized that successful investing requires patience and emotional strength. He explained that investors must be prepared for periods when the market behaves unpredictably. Those who remain patient during these periods often achieve the best long-term results. Staying the course does not mean ignoring reality. If the fundamental strength of a business changes significantly, rational investors must reevaluate their decisions. But temporary market volatility alone should not force investors to abandon well-reasoned strategies. Many investors lose wealth because they react emotionally to market cycles. During periods of excitement, they buy aggressively at very high prices. During periods of fear, they sell their investments at very low prices. This pattern repeatedly damages long-term results. Rational investors avoid this cycle by maintaining a long-term perspective. They remember why they invested in a business in the first place. They review the fundamental strengths of the company. They evaluate whether the original investment thesis still makes sense. If the business continues to perform well, the rational investor often chooses patience rather than panic. Another benefit of staying the course is the full power of compounding. Compounding requires time. It works slowly but steadily as investment returns accumulate year after year. Investors who constantly change their strategies interrupt this powerful process. But those who remain disciplined allow their investments to grow naturally over long periods. History shows that many of the most successful investors maintained consistent strategies across decades. They did not constantly chase new trends. They did not abandon their principles during difficult markets. Instead, they remained committed to rational thinking and long-term discipline. Staying the course also strengthens emotional resilience. Each time investors successfully navigate a difficult market period, their confidence in their process grows. They learn that market volatility is temporary. They develop greater patience and clarity. Over time, this experience builds a calm and disciplined mindset. Markets will always change. New technologies will transform industries. Global events will influence economic conditions. But the core principles of rational investing remain remarkably stable. Understanding businesses, demanding reasonable prices, protecting capital, thinking independently, remaining patient. These principles form a reliable compass that guides investors through changing market environments. By staying the course, rational investors allow these principles to work over time. They avoid emotional reactions that damage long-term performance. They remain focused on steady progress rather than short-term excitement. Over many years, this discipline can transform careful investing into lasting wealth. Conclusion: the mindset of the rational investor. Rational investing is not a secret formula or a complicated strategy. It is a way of thinking. It is the discipline to remain calm when markets become emotional. It is the patience to allow time and compounding to create wealth. It is the humility to keep learning and improving. The principles described throughout this book form a guide for thoughtful investors. Think long-term. Understand what you invest in. Ignore unnecessary noise. Control emotions. Focus on value rather than price. Demand a margin of safety. Diversify wisely. Practice patience. Avoid constant trading. Learn from mistakes. Think independently. Protect capital first. Stay humble. Build a personal system. And most importantly, stay the course. These ideas may appear simple, but their power lies in consistent practice. Over time, disciplined investors who follow these principles often discover that rational thinking becomes their greatest advantage. In a world filled with noise, excitement, and uncertainty, clear thinking remains one of the most valuable investments anyone can make.